大家好，这里是 Jackie S 观察笔记。这集邀请到 S 哥和 S 姐为大家讲解0050与006208投资 ETF 的选择分析，并且邀请您一同思考问题。让我们欢迎 S 哥和 S 姐。
Welcome to the deep dive. Today, we're really digging into a topic that so many of you have asked about. It's the ultimate showdown, maybe between two giants in Taiwanese ETF investing, 0005E0 and 006208. You've asked us to unpack the subtle differences, the pros and cons of maybe holding both, and how it all affects your long-term plans, even your taxes. So get ready for a shortcut to really getting your head around this pretty crucial decision.
That's right. And while these two ETFs, 0050 and 006008, they might look almost identical on the surface. I mean, they track the same thing, the Taiwan 50 index. They're definitely, let's say, devils in the details worth exploring. We'll be looking at, well, everything from their current fee structures, how well they actually track the index, to their operational strategies and the very latest on tax implications. Our goal here is really to synthesize all this info, connect the dots for you, and, highlight what truly makes a difference for you, the investor.
Okay, let's unpack this then. Let's start right at the beginning. What makes these two ETFs, 0005 and 006208, fundamentally similar? What's the common ground?
Right. So at their absolute core, both 005020, that's the Yuan to Taiwan 50, and 006208, the Fubon Taiwan 50, they're designed to do the exact same job. Think of them as, two highly skilled conductors leading the same orchestra, playing the exact same symphony.
Right.
They completely replicate the Taiwan 50 index. That means they aim to hold the same 50 largest companies in Taiwan in pretty much the same proportions as the index itself dictates. This strategy, it's called full replication. That's their foundation. And what that means in practice is that both ETFs are really striving to capture the long-term compound growth of these top Taiwanese blue-chip companies. So if you were to look back at their historical cumulative returns, say over 5-10 years, you'd find almost no significant difference. And that's precisely because their underlying investment universe and their main strategic goal are identical.
Huh. That's actually fascinating how two totally separate funds can chase the exact same goal. So, okay, if the destination is the same, where do the paths start to diverge? Where do the differences creep in?
Well, the first place, and probably the most obvious one for savvy investors, is always cost. Fees,
Yeah.
right? And this is where the story of 006208 and 006208 gets really interesting, because it's not static. It's actually a rapidly shifting landscape.
Right.
Both of these ETFs use what's called a tiered fee system.
Okay, tiered fees.
Yeah, maybe you could break down what that actually means and how it plays out right now.
Sure. So a tiered fee system is, well, it's essentially like a volume discount for the fund. The annual expense ratio, that's a total fee you pay, right, for management and custody services. It actually goes down as the fund's total assets under management, or AUM, get bigger. It's basically an incentive for the funds to attract more capital because, economies of scale kick in. Now, if we look at 0050, it's the undisputed heavyweight champion in terms of AUM. It's currently managing, well, over NT $600 billion. Some sources put it closer to like NT $630 billion even. And this huge scale means it already qualifies for the lowest fee tiers that are available. So its combined management and custody fees are really impressively low, sitting right around 0.13%.
Okay, 0.13% for the giant. And how does 00620, the strong challenger, compare on fees right now?
Yeah.
Where does it sit in this tiered structure?
Right, so 006208, while it's not as enormous as 05 year, it's still a really substantial fund. We're talking around NT $230 billion in assets. This size puts it in a slightly higher fee tier compared to 005. Its combined fee is typically around 0.15%.
0.15%.
Yeah, now look at that difference, 0.13 versus 0.15, that's about 0.02%. It might sound tiny, right? Negligible almost. But you've got to remember, over decades of investing, even these tiny percentage differences can compound into, well, quite meaningful sums of money. So historically, for the super cost-conscious investor, 0050s had that slight edge purely because it got big first.
But, and this is where it gets really crucial for thinking long-term. This is where the plot thickens, right? What happens if 006208 keeps growing like it has been? What if they both eventually reach the maximum possible asset scale defined in their fee structures? Does that historical fee advantage for 0050 stick around?
See, that's the critical insight for the future, isn't it? If both of these ETFs manage to hit that highest asset scale specifically, if they both grow past NT $1 trillion in assets, their fee structures are actually designed so that their management fees drop to an identical 0.05%.
Identical, wow.
Yeah, and their custody fees also converge. They become a uniform 0.025% for both. So you add those up, and the combined total fee becomes just 0.075% for both funds.
0.075%, that's incredibly low.
It really is, and what this tells us, loud and clear, is that 000 reciprocal cost advantage, the one it got from being the first mover and just being bigger for longer, well, that advantage is rapidly shrinking. In a future where 0062008 keeps pulling in assets, that fee difference could totally vanish, making them effectively identical on cost at that top tier. It's like a race to the bottom on fees, but, in a really good way for us investors.
Okay, so fees are potentially converging, which is huge. Let's talk about another really critical aspect of ETF performance, especially these full replication ones. Tracking error. For anyone who might be newer to this, what exactly is tracking error, and why is being precise so vital for funds like 0050 or 006208?
Right, tracking error. Think of it like this. It measures how faithfully, how accurately an ETF's return matches the return of the index it's supposed to follow, in this case, the Taiwan 50 index. Imagine you're trying to perfectly trace someone else's footsteps in the sand. Any little wobble, any tiny deviation, that adds to your tracking error. Now, for full replication ETFs like these two, which are literally trying to hold every single stock in the index at its exact weight, these errors are naturally very, very small. They're aiming for near-perfect imitation.
Near perfect, okay.
Exactly. But even these tiny deviations, when they happen day after day, year after year, they can compound over time and actually create a noticeable difference in your long-term returns compared to the index itself. So minimizing it is key.
Got it. Precision matters, even tiny bits of it. So when we look at the historical data, maybe over the last decade or so, how do 00050 and 006208 actually stack up against each other in this pursuit of precision? Is there a consistent winner?
Yeah, that's a great question. Based on the historical data we've seen, 006208 has pretty consistently shown a slightly tighter tracking error. Over the past decade, for instance, its error was often around, say, 0.08% to maybe 0.20% better annually than 0050's.
Better meaning smaller, closer to zero deviation.
Exactly, smaller negative deviation, closer to perfectly matching the index. So one set of numbers showed over the last 10 years, 0.008% difference per year on average there. Right, and this edge for 006208, it wasn't just a one-off. It's been observed across different time frames, looking at 1 year, 3 years, 5 years. It shows this subtle, but yeah, persistent outperformance in just replicating the index that tiny bit more accurately. It's like, maybe one conductor just has a slightly more precise flick of their wrist with their baton, keeping the orchestra perfectly in sync.
That's a really interesting finding because, both are considered top tier, right? They're both excellent at replication. So what actually accounts for this subtle yet seemingly consistent difference? Why does 06208 manage to stay just that little bit closer to the index? What's going on under the hood?
Yeah, it seems to come down to a few key factors that contribute to 006208's slightly better tracking. First off, it's partly about those internal expenses we mentioned earlier. Historically, looking over maybe the last 5 years, 06208 has tended to show slightly lower average internal expenses, like maybe around 0.31% compared to 005D's 0.44% in some analyses. Lower operational costs just naturally mean less drag on the fund's performance, right? It allows the fund to mirror the index's gross returns more closely. Every single basis point, every 100%, it really matters when you're aiming for this kind of precision.
Okay, so lower internal costs give it a bit of an advantage there. What about other operational things? Like how they handle cash coming in, or how they rebalance their portfolios. Are there differences there too?
Absolutely, that's another key area. 006208 is often described as having stricter cash management. What that generally means is it's more efficient, maybe faster, at reinvesting any cash it receives, mostly from dividends paid by the underlying stocks back into the market.
Getting it working again. Quickly.
Exactly, because when an ETF just hold onto cash, even for a short time, that cash isn't invested, right? It's not tracking the index's performance. That creates this little drag, sometimes called cash drag. So a fund that minimizes this idle cash, like 006208 seems to do, will naturally track its index a bit more closely over time. Think of it like idle money in your savings account not earning interest. Cash drag is that idle cash in the fund.
That makes perfect sense. Minimizing that idle time is crucial.
Okay.
So cash management is one thing. What about other operational philosophies? Maybe in how they actually adjust their portfolios when the index itself changes.
Yeah, there are definitely differences there too in their rebalancing strategy. 006208 tends to be, let's say, more precise or timely in its execution. It adjusts its holdings to match the index's changes very close to the official index announcement dates.
Right on the nose? Kind of.
Pretty much. 0050, on the other hand, based on observations, might sometimes adjust slightly earlier or maybe slightly later than the official date. Now, these small timing differences, even just a day or two around a major rebalancing event, especially if the market's volatile, they can cause these temporary little deviations from the index. It's subtle, for sure, but that consistent timing from 006208 could contribute to tighter tracking over the long haul.
Interesting. It's like one is trying to anticipate slightly, maybe, while the other sticks strictly to the schedule.
Could be, yeah. Or just different operational flows.
Okay. And what about the actual assets they hold? Is it always 100% physical stocks, or is there any difference in using things like derivatives?
Yeah, there's a bit of a nuanced difference there as well. 006208 generally shows a stronger preference for holding the actual physical underlying stocks as much as possible. Direct ownership, 0050Y, while it also primarily holds the physical stocks, has been known to occasionally use futures contracts, usually for hedging purposes.
Right.
Though we should be clear, this typically represents a very, very small percentage of its overall portfolio.
Right. Not a major part of the strategy.
No, not at all. And both approaches are perfectly valid, fully regulated strategies. But 006208's preference for just holding the stocks directly might sometimes mean slightly less complexity, maybe fewer potential costs associated with derivatives trading, however small. And that could be another small factor contributing to its marginally tighter tracking.
So it's more a difference in operational philosophy, maybe, rather than one being definitively better?
Exactly. It just contributes to their slightly different tracking characteristics over time.
Okay, so given all these subtle differences, fees may be converging, tracking errors slightly different, these operational quirks, a really big question comes up, doesn't it? If they both track the same index, hold basically the same stocks, does holding both 00050 and 006208 actually give you any real diversification? I mean, instinctively you might think, no, that diversifies absolutely nothing.
That's a brilliant question. And it really gets to the heart of what diversification means for investors, doesn't it? Because you're right, from a purely component stock perspective, holding both doesn't add diversification in the traditional sense. If your goal is to spread your risk across different industries or different asset classes like adding bonds or international stocks or real estate, then yeah, holding both 00005 and 006208 doesn't achieve that. You're still fundamentally invested in the same group of 50 large Taiwanese companies.
Right, same underlying stuff. Exactly. However, and this is where it gets really insightful, we can look beyond just the stocks themselves and think about something called structural risk diversification.
Structural risk diversification. Okay, that sounds complicated. How do you diversify against structure when the investment itself is identical?
Think of it like this. The blueprint for the building that's the Taiwan 50 index, it's exactly the same for both. But the construction crews building it, and the project management styles, that's the fund companies, Yuanta and Fubon, and their operational teams, they are different. And these different teams have slightly different operational mechanisms, different philosophies, different rhythms. For instance, like we just discussed, the rebalancing timings can vary slightly. 0050 might trade a bit ahead of the announcement, 006208 sticks closer to the date. That tiny difference in execution timing could mean a temporary price difference or execution quality difference that, while small, it exists. It's a structural difference.
Okay, so even with the same goal, their day-to-day tactics can differ. What about something major, like how they handle dividends? That's a big part of ETF returns.
That's another really significant operational distinction, yeah. 0005 has, at times, been observed using a strategy where it might sell some of its shares before they go ex-dividend.
Ex-dividend meaning after that date, new buyers don't get the upcoming payout.
Exactly. So they sell before that date, and then they buy those shares back after the ex-dividend date. Now, the potential reason for doing this is often related to managing or possibly reducing the dividend tax burden for the fund itself, which could, in theory, enhance the net returns passed on to investors.
Potential tax angle for the fund.
Potentially. However, this strategy introduces a specific risk, price difference risk. They're selling, then buying back, and the market price could move against them in that short window. 006208, on the other hand, typically handles dividends more directly. It usually just collects the dividends from the stocks it holds and then distributes them out to its shareholders without that intermediate selling and buying back step.
So simpler, maybe avoids that specific price risk.
Generally, yes. It's a more straightforward approach that avoids that particular risk. Now, again, neither way is inherently wrong, but these different approaches are another layer of structural difference that can lead to slightly different short-term outcomes.
Okay. that makes sense. And we also touched on derivative use and market makers earlier. How do those fit into this structural diversification idea?
They're absolutely part of the picture too. 00007, being the older, much larger fund, benefits from incredibly high liquidity and typically very stable, very narrow premiums or discounts to its net asset value, its NAV. That's largely thanks to a really deep and robust network of market makers ensuring efficient trading.
Right, easy to buy and sell large amounts.
Very easy. 006208, while still very liquid, let's be clear, it's highly liquid for an ETF. It has a slightly smaller group of dedicated market makers compared to 0050. This could occasionally, maybe during periods of extreme market stress, lead to slightly wider, more transient spreads or premiums discounts in its trading price. Again, usually very minor, but a potential difference. So the point of all these small operational differences, rebalancing timing, dividend handling, derivative philosophy, market maker depth, is that they can cause tiny variations in short-term returns and risk that are completely independent of whether the underlying stocks go up or down. And that is what provides this form of structural diversification. You're essentially diversifying away some of the specific operational risk, the timing risk, the strategy risk, or even the very rare risk of an operational hiccup from any single fund manager.
I see. So it's not diversifying the what in stocks, but diversifying the how, the fund operations. And how does this connect back to the tracking error we talked about? Could holding both actually help smooth out the overall portfolio's tracking error?
It absolutely could. Yeah, this brings us to a concept you could call tracking error complementarity. We already established that historically, 006208 has shown that slightly tighter tracking error, right?
Right.
So by holding both ETFs, you effectively reduce the risk that your entire investment deviates significantly from the index just because one of the funds hits a temporary patch of slightly worse tracking, maybe due to a complex rebalance or something. If, for example, 0050 has a slightly wider deviation in one period, 006208 might simultaneously be tracking closer. The effect is that your overall portfolio's tracking error gets diluted, potentially averaging out closer to the actual index performance in the long run.
Ah, like having two highly precise compasses. If one wobbles a bit, the average reading from both is still likely more accurate.
That's a great analogy. In fact, it can lead to more stable returns that hug the actual market index even more closely over time.
Okay, that's a pretty compelling argument from the internal mechanics side. Are there benefits related to how we as investors actually interact with these ETFs? Through our brokers or just in terms of buying and selling?
Yes, definitely. There's significant value in what we could call platform, transaction cost, and liquidity diversification. Think about it. Different ETFs might have different deals or better support on different brokerage platforms. For example, some brokers might offer lower transaction fees or even zero fees, specifically for setting up a regular saving plan in 006208. Or maybe better execution for odd lot trades in one versus the other.
Odd lot trading, that's buying less than the standard block of shares, right?
Yeah.
Like just a few shares at a time.
Exactly. Usually less than the standard 1,000 shares board lot in Taiwan. And that makes it much easier for people doing regular, smaller investments, like dollar cost averaging. Then there's platform risk itself. Imagine your main broker's app or website goes down during a critical market moment. It happens.
Oh, yeah. Nightmare scenario.
Right. If you hold both ETFs, maybe through different brokers or accessible via different platforms, you still have exposure and potentially the ability to act via the other ETF, reducing that single point of failure risk. And finally, liquidity. We mentioned 00CVZ's massive volume is great for huge single block trades, but 006208 structure, sometimes its lower unit price, can actually be better suited for entering or exiting positions in smaller, more gradual batches. That can be really useful if you're trying to average into or out of a position during volatile times.
So tangible, practical benefits for how you manage the investment day to day. What about the human side of things? Our own psychology when markets get crazy. Can holding both actually help with that psychological risk?
This is a really powerful advantage, I think, but one that often gets overlooked. Psychological and behavioral risk diversification. We all know that in really volatile markets, panic can set in. It's easy to feel overwhelmed and maybe panic sell your entire holding in a single ETF when you see its value dropping sharply.
Yeah, hitting the big red button.
Exactly. But if you hold two similar ETFs, it can enable a more measured approach, like a staggered entry or exit strategy. Instead of feeling forced to liquidate everything at once, you might feel more comfortable just trimming one of the positions, or maybe even adding to the one that seems to be trading at a slightly better discount to its NAV at that moment. It provides a kind of psychological buffer, doesn't it? A sense of having options, more flexibility. It can help you resist those purely emotional decisions.
Reducing the urge to make rash moves.
Precisely. It helps you stick to your long-term plan, which, honestly, is often the biggest single factor in achieving investment success. Staying invested is key.
Okay, that all sounds incredibly beneficial. Structural diversification, platform flexibility, psychological buffer. But there's got to be a catch, right? Holding two funds instead of one can't be a completely free lunch.
Yeah.
What are the downsides? Does it make things more complicated? Does it cost more?
You're absolutely right. There are always trade-offs. Nothing's ever completely free. The main disadvantage is probably a slight increase in just management complexity. It's simple, really. You have to track 2 ETFs instead of 1. That means slightly more hassle when it comes to monitoring performance, maybe doing your own rebalancing between them if you have a target allocation. And definitely when it comes to tax declarations, you might get 2 sets of statements, 2 sets of numbers to deal with.
Right, a bit more paperwork.
Bit more admin, yeah.
Yeah.
For most people, it's probably not a huge burden, but it is objectively more work than just holding one. Secondly, there is that slightly higher overall cost aspect we touched on with fees. You will be paying the management and custody fees for both ETFs. Now, individually, these fees are super low, as we've said, but cumulatively, your effective blended expense ratio across your total investment will be a tiny fraction higher than if you put everything into whichever fund currently has the absolute lowest fee.
But it's a weighted average, right? Not adding the 2 fees together.
Crucially, yes, it's a weighted average. So if you split 50-50 between 0050 and 006208 at, say, 0.1215%, your effective combined fee is around 0.005% to 0.00575%. Maybe, what, 0.005% to 0.01% higher than just holding the cheaper one. It's an incredibly small increase, almost imperceptible for most investors' bottom line over the long run.
Okay, really tiny cost difference. And what about that tracking precision we talked about? If 006208 tracks slightly better, does holding 0050 alongside it kind of dilute that advantage?
Yes, that's the third trade-off, the dilution of 0.0062008's edge. Your overall portfolio's tracking error will become a weighted average of the tracking errors of both ETFs. So if 006208 consistently delivers that tighter tracking, holding a chunk in 0000 will very slightly pull your combined portfolio's tracking error back towards the midpoint between the two. You won't get the full benefit of 006208's superior precision if it's only, say, half of your allocation.
Okay, so summing up the downsides. A tiny bit more complexity, a practically invisible increase in overall cost, and you slightly dilute the tracking advantage of the better tracker.
That's pretty much it.
So what's the overall value proposition then? Is that small cost worth the benefits?
Well, that's the core question for each investor, isn't it? For that very minimal increase in cost and admin effort, what you gain is potentially significant. You get greater operational flexibility, you diversify platform risk, you get the long-term potential benefit of offsetting minor tracking errors between the 2 funds, and crucially, you gain adaptability. You're better positioned if future fee changes or operational shifts favor one fund over the other unexpectedly. A lot of experienced investors really do see this parallel holding strategy as a kind of structural insurance for their core long-term investment. It's about building a portfolio that's resilient not just to market risk, but also to these less obvious operational or platform-specific risks, maybe even giving you that psychological edge, all for a cost that over a decade or more is almost negligible in the grand scheme of returns.
Structural insurance. I like that framing. Okay, let's pivot now to something that definitely impacts everyone's net returns, especially folks in higher tax brackets. The often confusing world of ETF taxation in Taiwan. We heard a really important update mentioned in the sources. Both 0050 and 006208 have now implemented something called the income equalization mechanism. What exactly is that, and why should investors care?
Yeah, this is a really crucial update because it directly affects how the distributions you receive from your ETF are taxed, or more accurately, how part of it might not be taxed. The income equalization mechanism in Mandarin, it's basically designed to help stabilize the per unit distribution amount that an ETF pays out, especially when the fund is growing really fast because lots of new investors are piling in.
Okay, so it prevents dilution of the payout for existing holders.
Exactly. Without it, if a flood of new money comes in right before a distribution, the total pot of distributable income would have to be spread across many more units, right? So the amount each unit gets would drop. With this equalization mechanism, a portion of the distribution you receive might actually come from this new capital flowing into the fund. In essence, it can be partly a return of principal, either your own or the principal contributed by new investors. And here's the vital part for taxes. that specific portion of the distribution, the part classified as coming from capital contributions, under this mechanism is not taxable.
Not taxable. Okay, that sounds good.
It is, from a tax perspective, because it's not considered investment income or gain. However, and this is equally important to understand because it's essentially a return of principal, it doesn't represent new wealth created by the fund's investments. It's just a way to keep the distribution per unit consistent. It's not free money gain.
Got it. Important distinction. So if that equalization part isn't taxable, what are the other main components of the distributions from these ETFs and how are they taxed here in Taiwan?
Right. So beyond that potential non-taxable equalization portion, the distributions from these ETFs primarily come from two other distinct sources, and they have very different tax treatments. First, you've got dividend income. This is usually identified on your tax documents by the code 54C. This is the straightforward income that the ETF receives from the dividends paid out by the actual stocks it holds. The dividends from TSMC, MediaTek, all the companies in the Taiwan 50 index.
Right.
And this portion, code 54C, is unequivocally taxable, no question about it.
Okay, taxable. How does that work?
It gets included in your annual comprehensive income tax filing, and it's subject to Taiwan's progressive tax rates, which, as you know, can range from 5% for lower income levels all the way up to 40% for the highest earners.
Right. And for those folks in the higher brackets, say 20%, 30%, 40%, are there specific strategies or choices they need to think about regarding this 54C dividend income?
Absolutely. This is where it gets strategic, especially for higher earners. If your marginal tax rate, the rate you pay on your last dollar of income, is 20% or higher, you have a choice. You can choose to not merge this dividend income with your regular salary and other income. Instead, you can opt to have it taxed separately at a flat rate of 28%.
Flat 28%. Why would you do that?
Well, if your regular income already puts you in the 30% or 40% tax bracket, paying a flat 28% on your dividends is obviously better than paying 30% or 40%, right?
Wow, okay, makes sense. Lower rate.
Exactly. Now, if you do choose to merge it with your comprehensive income, there is a tax credit available. 8.5% of the dividend income can be credited against your tax liability. But, and this is a big, but that credit is capped at NT $80,000 per household per year.
Okay, so the credit helps, but only up to a point.
Right, so for investors with substantial dividend income, that NT $80,000 cap might be reached quickly, making the separate 28% flat tax option potentially more advantageous, even considering the loss of the credit. You really have to run the numbers based on your specific income situation.
And there was something about health insurance premiums, too.
Yes, another layer. If a single dividend payout event from the ETF, not your total annual dividends, but one specific distribution exceeds NT $20,000, that specific payout is also subject to a 2.11% supplementary premium for the second-generation National Health Insurance, NHI. This applies regardless of how you choose to file your income tax, merged or separate.
Wow, okay, so dividend income 54C is definitely taxable, potentially complex depending on your income, and might have that extra NHI charge.
Got it. What's the other main source of income in the distribution then?
The second major source is typically labeled as property transaction income, and it usually carries the tax code 76W. This income comes from a different place. It originates from the capital gains the ETF realizes when it actively buys and sells the underlying stocks within its portfolio. This happens, for instance, when the index rebalances and the fund manager has to sell stocks that are leaving the index or reduce weights, and buy stocks that are entering or increasing weights. Any profit made on those sales contributes to the 76W category. Okay, so gains from the fund trading stocks. How is that taxed?
Now, here's the really crucial part for tax planning. This portion, the property transaction income, 76W, is currently tax-exempt in Taiwan.
Completely tax-exempt, regardless of your income.
That's right. As of now, capital gains from trading Taiwanese stocks, whether directly or through an ETF like this, are not subject to income tax. So any part of your ETF distribution that falls under code 76W is effectively tax-free income for you.
Okay, that's a huge difference compared to the 54C dividend income, taxable versus tax-exempt. This brings us right back to that point we hear often, especially relevant for high-income investors, that 0050 has historically been seen as more tax-friendly. Is this because of the mix between 54C and 76W? And is it still true today, given how things change?
This is precisely where the rubber meets the road regarding tax efficiency. And yes, it revolves around the mix or the proportions of these different income sources within the distribution. Even though the basic mechanics, the existence of 54C, 76W, and potentially the equalization mechanism are the same for both 0008 and 006248, the actual ratio between taxable dividend income, 54C, and tax-exempt property transaction income, 76W, in any given distribution can differ significantly.
And why do they differ? Is it just random?
Not random, no. It depends on the specific distribution policy and operational choices made by each fund manager. Yuanta for 0056 and Fubon for 006208. Factors influencing this mix include overall market conditions. Did stocks pay high dividends that year? The actual dividend payouts from the specific 50 companies in the index, and importantly, the fund manager's strategy for realizing capital gains throughout the year. They have some discretion in when they sell stocks and realize those tax-exempt gains, 76W.
So the fund manager's actions can directly impact the tax characteristics of the distribution.
Absolutely. Their trading and operational strategy directly influences that 54C versus 76W split.
Okay, so how has that mix been trending recently for 00608 and 0050? Is there a noticeable pattern?
Yes. Based on recent distribution history, there has been a noticeable trend. 006208 has recently shown a tendency to distribute a higher proportion categorized as dividend income, 54C. In some recent distributions, it was reportedly even close to 100% 54C.
Wow, almost all taxable then.
Pretty much. This means a larger chunk of the money you receive from 006208 is subject to income tax, and potentially that 2.11% supplementary NHI premium if the payout is large enough. Consequently, this trend makes 006208 appear less favorable, specifically for high-income earners who are laser-focused on minimizing their current tax bill. More of their distribution is hitting their taxable income line.
But maybe okay for lower income folks.
Exactly. For investors in lower tax brackets, say the 5% or 12% bracket, merging that 54C dividend income might still be perfectly fine, or even advantageous, especially if the 8.5% tax credit up to NT $80K gives them a net benefit or refund. The tax impact is much smaller, or even positive for them.
Okay, so if 006208 has been leaning towards more taxable 54C, does 0050 show the opposite pattern?
Precisely. In recent periods, 0070 has generally shown a tendency to distribute a higher proportion categorized as tax-exempt property transaction income, 76W, and therefore a relatively lower proportion as taxable dividend income, 54C.
Ah, so more tax-free money in the payout.
Exactly. This composition makes 00050 appear more attractive right now for high-income earners focused on tax efficiency. A larger slice of the distribution pie they receive is completely tax-exempt, and even for the remaining taxable 54C portion, they still have that option to elect for the separate 28% flat tax if it's beneficial compared to their marginal rate. So the recent trend in 0050's distributions has certainly been more favorable from a pure tax minimization standpoint for those in higher brackets.
That is a really critical distinction, but I guess the big warning sign here is recent trends, right? These proportions aren't set in stone. They could flip next year.
That is the absolute crucial caveat. You've hit it exactly. These proportions are highly dynamic. They can and likely will change from year to year, even distribution to distribution. They depend heavily on market conditions, like overall dividend levels, index changes, forcing trades, and critically, the fund manager's strategy for that specific period. Maybe one year they decide to realize more capital gains, boosting the 76W portion. Maybe the next year, dividends are high and they trade less, boosting 54C. Therefore, and this is vital, you cannot rely on last year's ratio for this year's taxes. You absolutely must refer to the official income distribution notice that the fund company, Yuanta or Fubon, releases before each distribution.
That notice is the definitive source.
It is the definitive official source. It'll tell you the exact breakdown of how much is 54C, how much is 76W, how much is from the equalization mechanism for that specific distribution. That's what you use for your tax filing. Always check the latest notice.
Okay, super important point. Always check the official notice for the tax breakdown. Right, let's try and make this a bit more concrete. To give you listening a clearer picture of how these subtle differences, the fees, the tracking, maybe even taxes implicitly might play out over the long haul, we've run some simulations. Let's imagine starting with, say, NT $1 million invested over 20 years. We'll use the current fee rates we discussed, maybe 0.13% for 0050, 0.1215% for 006208, and those historical tracking errors like minus 0.51% to 0050 minus 0.43% for 006208. First scenario. What if things go well? A nice, stable bull market, maybe an average 8% annual return each year for 20 years. How do they compare?
Okay, in that steady 8% growth scenario, the simulation outcome is pretty clear, though the difference is small. 006208, mainly because of its slightly lower fees in this specific example and its slightly better tracking error, it performs marginally better. For instance, after 20 years, the simulation might show 006208 growing to around NT $4,690,000, whereas 0050 might reach about NT $4,660,000.
Okay, so difference of about NT $30,000 over 20 years on that initial million.
Exactly. Now, NT $30,000 isn't nothing, but as a percentage of the final amount, it's really quite small, less than 1%. So this simulation really highlights just how incredibly close their long-term performance is likely to be under those kind of ideal stable conditions.
Yeah.
It really hammers home that the choice probably isn't about one being dramatically superior in pure return potential.
Right. What happens if the market isn't so smooth? Scenario 2. A high volatility market, maybe years with big gains followed by years with losses, averaging out similarly over time, but much bumpier ride. Does 006-208's better tracking error make more difference then?
Yeah, in those choppy, volatile markets, that superior error control of 006-208 does tend to become a bit more noticeable. I mean, both ETFs are going to follow the market's wild swings up and down, obviously, but 006-208's slightly tighter tracking means it deviates less from the index's true path during those swings. This could translate into a slightly smoother experience relative to the index, maybe capturing slightly more of the upside or losing slightly less of the downside compared to a fund with wider tracking error. And interestingly, in these volatile scenarios, simulations sometimes suggest that parallel holding or holding both can actually help stabilize the overall portfolio's fluctuations relative to the index.
How so?
Because their tiny individual micro deviations from the index might in some periods actually cancel each other out to some extent. One zigs slightly when the other zags slightly, and the average stays closer to the line. So at high volatility, 006-208 likely still maintains its slight edge individually, and a 50-50 split might sit right in the middle but offer a bit more stability around the index return.
Okay, now for the unpleasant scenario. What if the market tanks? Scenario 3. A bear market. Let's say an average loss of -3% per year for 20 years. Does that tiny fee and tracking difference still matter when everything's losing money?
Well, sadly, yes, it still matters, although maybe psychologically it feels different. In a prolonged bear market, where both ETFs are obviously going to see their value decline, 006-208 slightly lower fees and tighter tracking mean it should, in theory, lose slightly less money than 0050. So if 0050 drops to, say, NT $505,000 in this grim scenario, 006-208 might end up slightly higher, maybe around NT $520,000.
You still lose, but you lose a tiny bit less.
Exactly. Neither outcome is good, obviously, but it just underscores that every basis point of drag from fees or tracking error works against you in both up and down markets. The fund with less drag will bleed slightly less when things go south.
Right, makes sense. Okay, one more scenario. Many listeners are regular savers, putting in a fixed amount every month. Scenario 4, investing NT $10,000 per month for 20 years. How do they stack up for the consistent long-term saver?
Yeah, this is a really common and important strategy. For regular savers using dollar cost averaging, 006-208 often looks particularly well suited. And it's not just about the potential fee advantages, although those help over time, it's also about practicality. 006-208 generally has strong support across platforms for odd lot trading, making it easy to invest that exact NT $10,000, even if it doesn't buy a round number of shares. And a DRP support dividend reinvestment plans is often readily available, meaning your dividends automatically buy more shares, which is fantastic for compounding over long term without you having to do anything.
And sometimes fee waivers too.
Exactly. Some brokerage platforms specifically offer reduced or zero transaction fees for setting up regular monthly investments into 006-208, which directly boosts your net returns. So you combine the convenience, the DRP, the potential fee waivers, and the slightly better tracking. Our simulation for regular contributions generally shows a similar pattern. 006-208 typically ends up with a very small lead after 2 decades of consistent saving.
Okay, so it seems particularly friendly for that regular saving approach. Let's zoom out again for a moment, thinking about the long-term and dividend reinvestment, but considering the impact of their current size and fees. We ran a 10-year simulation, NT $1 million initial, 10% annual return, 3% dividend yield. How did the current scales affect this?
Right, looking at their current sizes and the current fee tiers is important. At its massive current scale, Severus 50's effective internal expense is estimated to be around 0.12% or 0.13%. 006-208, being smaller, might be closer to 0.15% currently, depending on the exact AUM level. So right now, 00050 does have that slight edge in pure cost efficiency, especially for making a large lump sum investment today and just want the absolute lowest fee currently available.
And if you held both, 50-50.
If you did a combined parallel holding, say NT $500 per year, in total fees on the million, it's not double the fees, it's a blended rate, still very low in absolute terms.
Okay. But then what about the future scenario? If they both reach that NT $1 trillion maximum scale, where fees converge to 0.075%, how does that change the long-term dividend reinvestment picture?
Well, if and when they both hit that scale and the fees become identical at 0.075%, the long-term profit forecasts from simulations become incredibly close. Almost indistinguishable, really, whether you hold only 0050, only 006208, or a mix of both. Once the fees equalize at that super low level, the tiny differences in tracking error become almost the only differentiating factor, and as we've seen, that difference is very small. So the overarching conclusion from looking at all these scenarios, bull markets, bear markets, lump sums, regular savings, current fees, future fees, it's pretty consistent. While there are differences, especially right now, their long-term impact on your total return is expected to be remarkably small.
Because they track the same index.
Exactly, because they track the same index, and their fees are on a path towards potential convergence at the top end. For the truly long-term investor, the final choice probably hinges on factors beyond chasing that last 100% in simulated returns.
Okay, so after this incredibly detailed dissection fees, tracking, operations, taxes, simulations, how does someone actually make the choice? Let's try to offer some tailored advice for different investor types. What about someone who is really focused on minimizing costs right now, or maybe someone who trades more actively with the shorter-term view?
Right. For the investor whose absolute top priority is minimizing the current expense ratio, or perhaps someone who anticipates trading more frequently, 0050 is probably the primary consideration right now. Its sheer size gives it that immediate, albeit small, fee advantage today, and its unparalleled liquidity makes it extremely efficient for getting in and out of large positions quickly with minimal market impact. If you happen to hold 006208 currently, and this immediate cost efficiency is your driving goal, you could consider gradually switching over to 0005. But I'd emphasize gradually sell in batches to avoid potential price impact from a large sale. And always weigh the transaction costs of selling and buying against the very small fee difference you're hoping to save. Don't let the trading costs eat up the potential savings.
Good point. Manage the transition carefully. Okay, what about the opposite type of investor? Someone who is a dedicated regular saver, putting money in every month, or someone with a truly long-term buy and hold for decades mindset. Does the advice shift?
Absolutely. The perspective shifts quite a bit for them. For regular savers and committed long-term holders, a more nuanced strategy is often better. For you, seriously considering either parallel holding of both ETFs or perhaps even favoring 006208 for new investments makes a lot of sense. If you already hold 006208, there's generally no strong reason to rush out and sell it based on the current tiny fee difference. You can likely just keep holding it. For new money coming in, you could strategically allocate it towards 0050 to balance things out, or you could flexibly adjust your contributions between the two based on, say, which one seems to have better momentum, or if one platform offers a better deal for regular saving. And 006208 has some really compelling features specifically for these long-term regular investors. We mentioned the odd lot, friendliness, great for investing exact amounts. The strong DREP support automatic dividend reinvestment is huge for compounding. Potential fee waivers on regular plans.
And future potential, too.
Yes, exactly. Don't forget the future potential. If 006208 continues to grow its assets, maybe hits NT $300 billion, then NT $500 billion, it automatically unlocks further fee discounts within its tiered structure, closing that gap with 005. And critically, it's already approved for future stock splits, like one share becoming 3 or 1 becoming 5. That would dramatically lower its per unit price, making it even more accessible and psychologically easier for small, regular investments. That's a big forward-looking advantage.
Yeah, that stock split potential is interesting for accessibility. Okay, what about investors who like a more structured but adaptable approach, maybe using a core satellite strategy?
Yeah, for those who like dynamic allocation, that fits perfectly. You could structure your holding using a core satellite framework. Maybe 00080, due to its established size and liquidity, forms a large core of your Taiwan 50 exposure. Then 006208 could serve as a satellite, making up a smaller portion, say 20% or 30%. This way, you capture its potentially tighter tracking, its future fee reduction potential, and its accessibility features. You might set a target ratio, like 80.20 or 70.30, 00006208. This gives you a clear structure, but also the flexibility to adjust that allocation over time as your funds grow, or if the relative merits of the two ETFs shift due to fee changes or other developments. It's a balanced, adaptable approach. Okay, let's crystallize this whole comparison. Can we quickly summarize the main pros and cons for each of the three main strategies? All 00080, all parallel holding. Sure, let's break it down. Strategy 1, all 00 Pros. It has the longest history, it's the original pioneer. It offers extremely high liquidity, ideal for very large trades. Its massive scale provides a certain stability, and currently at its size, it likely has slightly lower fees than 006208. Cons. Its share price per unit is higher, which can feel like a barrier for small investors, though odd lot trading helps mitigate this. And historically, its tracking error has been slightly wider than 00628's.
Okay, strategy 2, all 00620.
Strategy 2, all 006208. Pros. It has a lower, more accessible share price per unit, and that's set to become even lower after a potential future split. It boasts of better historical tracking error, showing more precision. Its fees are very competitive and set to fall further if its assets grow. Plus, strong growth potential and features friendly to regular savers. Odd lots, DRIP.
Cons.
Its overall fund size is smaller than 0050's, meaning slightly less liquidity compared to the absolute giant, though still very good liquidity for most purposes.
Got it. And finally, strategy 3, parallel holding.
Strategy 3, parallel holding. Pros. You diversify fund manager risk. You're not reliant on just one institution, Yuanto or Fubon. It gives you great flexibility to allocate between them based on real-time fee changes or trends. It lets you observe both, potentially reducing behavioral mistakes. And you get that powerful structural risk diversification operational platform psychological. Cons. It introduces slightly more management complexity, tracking two things, more paperwork. There's that potential for a tiny, almost negligible increase in your overall weighted average cost. And remember, the diversification benefit is structural, not in the underlying stocks. You're still just holding the Taiwan 50.
Okay, that's a fantastic summary. So after weighing every single angle, fees, tracking, operations, taxes, scenarios, pros and cons, what does this all boil down to for you, the listener, trying to make this choice? What's the real deciding factor at the end of the day?
After all this deep analysis, here's what I think is the fundamental truth. Regardless of which of these truly excellent ETFs you choose 0050,000, 6208, or if you decide to embrace the flexibility of holding both, the single most important factor isn't necessarily about squeezing out that last 0.01% from fee differences or tracking error. It's really about your personal conviction. It's about whether the choice you make gives you the peace of mind, the confidence, the unwavering belief to hold on to it for the long term. We're talking 10 years, 20 years, maybe even longer.
Holding tight through thick and thin.
Exactly. That long-term commitment, that discipline to stick with your plan through market ups and downs, that is the real key to truly benefiting from the power of compound growth that investing in Taiwan's top 50 companies offers. The subtle differences we've explored today, they're important for optimizing for fine-tuning, but consistent long-term adherence to your plan, that will almost always be the most powerful driver of your ultimate investment success.
That's a powerful reminder. We've really gone deep today into the world of 00M0 and 006208, haven't we? We've dissected the subtle differences in fees, tracking errors, operational styles, and those really important complex tax implications. We truly hope this analysis gives you the clarity and maybe the confidence you need to navigate your own investment journey with these ETFs.
Indeed. And I think what we've clearly seen is that while their long-term performance is likely to be incredibly similar, those granular details really do matter for choosing the optimal strategy for you. Things like the operational nuances, the small tracking differences, and especially that crucial dynamic aspect of tax treatment. How much is dividend income versus capital gains? Those can significantly influence which approach best suits your specific situation, your income level, and your priorities.
So wrapping it all up, what does this really mean for your final decision?
Well, let me leave you with this, maybe a provocative thought to chew on as you weigh your options. When you have two truly excellent ETFs like 0050 and 006208 that are becoming almost indistinguishable in terms of their core costs and performance potential over the very long term, are you personally willing to accept maybe a tiny bit more management complexity or that minuscule potential increase in overall fees in exchange for getting potentially enhanced operational flexibility, that structural risk diversification we talked about, or maybe simply that invaluable psychological sense of security that comes from not having all your Taiwan 50 eggs in just one single operational basket? The answer to that deeply personal trade-off, how you value those softer benefits against the tiny costs, that might just be the most critical factor in your ultimate investment decision.
感谢收听本集趋势观察，一手掌握之0050与006208投资 ETF 的选择分析。我是 Jackie， 下次见，愿平安健康随风至您身边。